Hello and welcome. My name is Jesse Durham, and today we're going to be discussing the basics of the infinite banking concept as conceived and described in R. Nelson Nash's book, Becoming Your Own Banker, and we're going to do it in
just 20 minutes.
Let's start with money. And to preface, let me say that all these different things that we'll consider in evaluating the basics of the infinite banking concept, we're going to do through the lens of a play. So theme, characters, plot, because Nash said in Becoming Your Own Banker, his book, that we need to recognize who the characters are in the play. So let's start with money being a primary character in this play. Is the dollar, and we would agree that money is just a means of exchange. Okay, we would exchange money for a car, or money for a vacation, or money for groceries, money for college education, money for a wedding, money for business equipment, money for a home, but also those things are sold for money. So money is simply the means of exchange. Here in America, that's the dollar. So let's ask then, is the dollar worth more today or in the future? That's not a trick question. I think that if we look in history, we get a track record. Let's recognize what a candy bar would have cost 5 years ago, 20 years ago, 50 years ago versus what a candy bar costs today. What may it cost in the future? Is that likely to go up or go down? Also, taxes. Are we likely to be taxed more in the future? And may we also even be taxed on more things in the future? Again, history bears a certain track record, it would seem. And when we evaluate, let's say back to 1913 versus today, and then let's consider looking into the future. So these are questions to consider on this actor of money. Next, because we are conventionally told to park our dollars in different qualified plans and such, so to park it, to stow it somewhere, to save it somewhere is the wording a lot of the time. Would we rather be taxed then on the seed or on the harvest? I would argue that it would be more profitable to be taxed on the seed and not the harvest. Next, let's go to banks. And let's start with the superficial. Aren't banks the nicest buildings with the best kept grounds in the prettiest parts of every town? Okay, who pays for that? Let's, again, just staying superficial for the moment. Who pays for that? The customer pays for all of that. Pays for the building, pays for the groundskeeping, everything that we see at a commercial bank. And don't those banks have branches in every town and every city? They're all over the place. Now let's transition to the function of banking. Now, whether we're talking about a river and the land that's on either side of the river, well, what do we call that? Or in a field covered with snow and the snow's pushed up to the sides of the road, let's say, what's that called? A place where you can donate blood is called so bank. Bank is this term that is just showing about where things are accumulated, piled up, stored, saved, built, accrued. So a blood bank, river bank, snow bank, and there are lots of other references. Now, it's worth noting that banks, commercial banks, are the largest purchasers of whole life insurance. Now that's going to tie into the next actor. So far we have money as an actor in this play, commercial banks as an actor in this play. Next is going to be whole life insurance. Now the insurance industry has literally been around for over 200 years. Now I'll be very specifically talking about mutual companies that pay a dividend with whole life policies. Now there are several characteristics to these policies, such as
transferability, guaranteed growth, liquidity, tax-deferred and tax-free benefits, protection against volatility in the market, litigation protection, inflation protection. It's easy to manage. There are no hidden fees or penalties. It's reputable. It's safe. It is consistent. It is permanent. There is private ownership. There is control. There is guaranteed growth. And there is a highly respectable anticipation of a dividend.
I'm not married to any one particular life insurance company. I'm married to my wife, Lauren. and I own multiple policies with multiple companies. Now we arrive at the plot. The plot is going to be what's described in Nash's book as the problem. You see, we pay approximately 35% of every dollar in interest. Now, that is money that forever leaves our family, our business, that forever leaves us, never to return. And the conventional thinking is to try to focus on the 10% that we should be saving, or some approximate number, for retirement or for the future, while overlooking the vastly more important issue of this great volume of interest that we are paying over our lifetime, because everything is financed. Either we are borrowing someone else's money and paying interest for that use, also on their terms and conditions, and the alternative is to amass capital somewhere and forfeit the opportunity to earn interest on that money that we otherwise could have if we would have used it. And let me say here that because I've mentioned that one of the actors in this play that we're considering is whole life insurance, and Nash said this in his book repetitively, our need for finance is far greater than our need for a death benefit. So the problem is the bleeding out of interest that we're paying to others. So while we're being told set aside 10%, 15%, and we know that the vast majority of folks are not saving, we don't even have several $100s for a medical emergency, the vast majority. And yet we're told to park money, not touch it for 10 years, 20 years, 30 years, 40 years. Set it and forget it, and just hope and expect that we will be able to benefit a greater amount in the future. But what that does is that overlooks the natural law of motion. Our lungs breathe air in and out. Our bodies circulate blood. Rivers run. Oceans have tides. The solar system is moving. So motion is a natural law. And yet we're told conventionally to park our money, to set it and forget it for, again, those 10, 20, 30 years or so, overlooking the economic value that could have been added otherwise if we were to maintain control of the banking function in our life. And that is how we will be addressing this plot, this problem. The whole theme of this information is to promote the idea that you can become your own banker, that I can become my own banker, with logic, reason, prophecy, and mostly imagination. These are 4 characteristics that Nash promoted to us: being reasonable and logical in our approach, but stretching our imagination to figure out how to become our own banker using these actors that we're already aware of. The banking function, coupled with whole life insurance that's been properly structured with a mutual company that pays a dividend for our need for finance, using money. But not just using money, but getting that back into our system. So let's talk about 3 rules of practicing the infinite banking concept. The rules are to pay yourself first, pay yourself with interest, and recapture the money. Now, let's recall the analogy so famously used in Nash's work, and that is going to be the grocery store. What Nash asked us to do was put ourselves into the position of ownership of a grocery store and consider things such as stocking the shelves and how that works, and how that requires discipline and forward thinking on our part, but then also sound practices such as not stealing the peas, not succumbing to the temptation to walk out the back door with the peas. It's our store, right? So the sound practices of running a grocery store we bring to bear in considering the idea that we can become our own banker as well. So I highly encourage you to read or refresh your thinking on the grocery store. If at any point you begin to question, why? Because we need to recognize, again, who the actors are in the play and what their role is. If you're not a thief, if you're not a liar, if you're not a robber, then you're not going to steal the peas and walk out the back door. Now let's address the human problems that Nash so well exhibited to us in his book. The Willy Sutton Law. Let's start there, because he said that folks want to separate us from our money. Now that may be legally or illegally. Willy Sutton was a famous outlaw. So legally or illegally, folks would like to separate us from our money. Again, plenty tell us to park our money in this qualified plan for 10 years, 20 years, 30 years. Don't touch it. And yet, we know that that money is not sitting there. Again, if you take a dollar bill and deposit it at a commercial bank, does that money sit there? Or isn't it being turned over and over and over again? I mean, if you wrote your name, deposited a dollar bill at your commercial bank, and you showed up the next day, that same dollar would not be there. If you showed up within an hour, that same dollar would not be there. They're using it. They're recognizing the natural law of motion. So the Willy Sutton Law is not to be overlooked. The next, the golden rule. He who has the gold makes the rule. When you refrain from abdicating the banking function to someone else, to a commercial bank, to a third-party lender, and you account for your need for finance, you procure and privately own an entity that is under your control, and you begin to finance the things that you're going to do anyway for yourself, he who has the gold makes rules. Next is going to be use it or lose it. Either, because again, we finance everything that we do. Either we are borrowing someone else's money and paying them interest for it, or we set aside cash somewhere and we forfeit the opportunity to earn on that money that we otherwise could have enjoyed. So we're either going to use it or lose it. Next is the arrival syndrome, and this one is so dangerous. They all are. But I think highly on this one because of how pride and ego and preconceived ideas can cut our thinking short. We think we've arrived, and there's that famous or infamous saying of, I know that cuts off our ability to progress and to grow and to expand. So the arrival syndrome, very dangerous. And then ultimately creating the entity. How do we create a privatized banking system? Now that leads us right into Nash's book. To create our own bank that can eventually expand to accommodate all of our income, our entire financial footprint can be accounted for in our own privatized banking system, and it'll be done with whole life insurance from mutual companies that pay a dividend and that have been properly structured for the banking purpose, where all these different aspects that Nash covered in his book, rate of return, retirement, a college education, comparing different vehicles, financial vehicles, cost of acquisition, and even distribution of age classes, legacy, all these different issues that matter to us are brought to bear by becoming our own banker. Now let me give you 5 principles right from R. Nelson Nash in how to appropriately practice the infinite banking concept. First, we must think long range. Nash constantly encouraged for us to think and act intergenerationally. So when I say long term, I'm not just talking about into retirement or passive income, which is good that we can start there, but to really consider what it would be like to impact with this idea that you can become your own banker, the legacy of our 4th, 5th, 6th, 7th, 8th generation. Okay. The next thing that he encouraged us to do was to rethink our thinking. You know, we all come into this idea with a pretty natural impulse, the idea of becoming a banker, to say, I wish I knew about this 5 years ago, 10 years ago, 50 years ago. Okay? So regardless, question everything. Consider everything. Rethink your thinking. Because we all bring noise into this revelation, this connection that we have with the infinite banking concept. At whatever point you're at on your journey, whether you're already a client with multiple policies or you're vetting this idea for the first time, rethink your thinking. Next, don't be afraid to capitalize. Remember, he who has the gold makes the rules, the golden rule. So the principle of not being afraid to capitalize, I mean, how big do you want your numbers to be? How quickly do you want to be able to impact whatever is in your financial footprint, the things that you're already doing? And I'm talking about without taking additional risk, without losing control, without changing your cash flows. You still cannot be afraid to capitalize your own system that you will own and control. Can't be afraid to capitalize. If that doesn't make enough sense, again, this is the basics. Go back to Nash's book and read about the grocery store. Next, don't do business with banks. I know we may make some enemies there. Nash very well may have as well. He would say that banks lend money that doesn't exist, and that is evil. That's what he said about it. So don't do business with banks. We don't own that. We don't control that. We don't benefit from that. That's not impacting our legacy. And I'm not saying to completely overlook the opportunity to use other people's money, but being the banker, even so, being the one in control, being the one dictating the terms and conditions, and being the one that recaptures the interest and the capital. And then finally, be an honest banker. Be an honest banker. Don't steal the peas. Don't walk out the back with the peas. Be an honest banker. Pay yourself first. Pay yourself with interest. Recapture the money. Be an honest banker. Now, ultimately, here's the case. If you are a client and you are checking this video out, thank you. Good luck. Continue on your education journey. If you are vetting this idea for the first time, remember the basics with me here. We've talked about looking at the basics of the infinite banking concept in this play analogy. There are these actors. The plot is that there's a very big problem here where we're not in control, nor are we the beneficiaries of the banking function in our life. And then there is the theme of we can become our own banker. So remember, when you are vetting this idea, when you are reading Nash's book, Becoming Your Own Banker, and you're reading his second book, Building Your Warehouse of Wealth, and you're diving here in on the channel and learning more, you're investing in yourself, investing in your knowledge, you're rethinking your thinking, remember that ultimately, nobody's getting out of this alive. I like to use the term graduate. So either we live. From the time that you see and hear this, either we live or we graduate. We pass on. In either of those scenarios, if over the course of our lifetime we were our own bankers, are we or are we not better off for having begun this journey? When we graduate, will we or will we not be better off to have had the opportunity to teach and educate and share this idea that you can become your own banker to those that we care about, our heirs, our beneficiaries, and not only that, but we've practically accommodated for a tax-free transfer of wealth via the death benefit of the policies that we own. So whether we live or whether we die, we're going to be better off. So once we know that, how soon do we want to start? I mean, if we recognize that there is a constant, guaranteed, upward growth trend of our cash values, of our death benefit, from the moment that a policy is enforced that we own and control, that's been properly structured with a mutual company that pays a dividend, once we recognize that there is this constant upward growth trend, how soon do we want to start? The best time to plant a tree is 20 years ago. The next best time is today. Again, my name is Jesse Durham. I hope that this has been helpful for you If you'd like to continue this conversation, I'd love to be able to hear from you. You can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. This has been an absolute pleasure for me. I look forward to our next conversation. Have a great day. Take care. We could look all the way back to 1913 and Hello and welcome to this Basics of IBC. And this will be just fine. American flag. Hallelujah. Video is on and running.